The Swiss franc has been strengthening against all efforts by the Swiss National Bank. Joining us now is Alessio de Longis. Alessio manages Oppenheimer Funds Currency Opportunities Fund. His global debt team helps to oversee $20 billion. Alessio, nice to see you here.
Good morning, Erik.
Let's talk about what's going on in Switzerland, because it is out for the most part of the focus of mainstream American investors. But goodness, it's an extraordinary story. What's happening? Why can't everybody is turning to central banks these days, but the Swiss National Bank seems almost powerless to stop this currency from strengthening and threatening the Swiss economy.
You're absolutely right. Over the last 3 weeks, the Swiss National Bank has taken major steps through rhetoric and action to stem currency appreciation. Now, let's remind ourselves that what we are trying to accomplish here, because we've been in this place many times in the past, Japan, Switzerland, over the last 2-3 years, countless, right? The Swiss National Bank is trying to prevent excessive appreciation with excessive volatility. They're trying to stabilize the currency, the speed of the appreciation, rather than really believing that they can establish a new trend of weakness. Because the problem here is that there are three major channels that are supporting the Swiss franc strength, and it's all relatively based on fundamentals. You have a massive support from the trade flows and the current account surplus, massive 14% of GDP, current account surplus in Switzerland. And then you have capital flows looking for that safe haven characteristic, and is due primarily to two realities in the world: the European sovereign debt crisis, as well as the US growth slowdown. And in the current regime, all these three factors are likely to remain in place.
So the steps that the Swiss have taken, which include providing more liquidity, but not intervening, is that because they understand the lessons that the Bank of England learned fighting with George Soros, that there's simply too much money at work in international markets to try to fight against investors, especially if you're a country as small as Switzerland?
It's a good point. And not only, they learned their own lesson in 2009 and 2010 when they did intervene in the currency market, and they were not able to stop it. Now, what they are trying to do now is slightly different, but it may achieve actually just the same results. What they're trying to do is to lower the interest rate, actually make it a negative interest rate for foreign investors buying the Swiss franc. The yield on the Swiss franc versus the US dollar went from 0 to minus 1.5%. So, but in the current regime,
trying to disincentivize any investment opportunity whatsoever.
Exactly, but is that going to work necessarily? If you think about that, gold carries a negative yield as well, because the cost of carrying it. And we have seen where gold prices have gone. Over the last 2-3 years, what we have learned is that negative carry or negative interest rates do not necessarily represent an impediment to currency strength or asset appreciation. Look at Swiss franc, look at Japanese yen, look at gold.
Quick question for you, Alessio. With the situation, it's clearly a difficult situation for Switzerland, but at what point does the appreciation of the Swiss franc become a problem for other people, become a problem for other nations, become perhaps a problem in some way, shape, or form that the EU has to confront?
Well, it has become already, they are intervening because they're afraid it's going to be a problem for them, not much on the exporter side, but probably because of risks of deflation. As we know, Switzerland runs a 2% inflation target, but currently inflation is at only 0.5%. So with a massive appreciation of 30% of the Swiss franc and an imports as percent of GDP of about 40%. Imagine the pass-through in terms of disinflationary forces coming into the economy. Second of all, the region in Europe that is at risk with excessive currency appreciation in the Swiss franc is Eastern Europe, because of all these mortgages that are denominated in Swiss francs, and obviously Poland, Hungary the household sector is trying to manage the exposure of those Swiss-denominated mortgages.
At the very least, the Chinese have a few options. It seems as though the Swiss have almost run out of options. Alessio, it's great to see you here in the Inside Track. Alessio de Longis of Oppenheimer Funds.